So the anarchy that went on yesterday in Washington, D.C. shouldn't have much of an impact on investor portfolios. The election from November and the election in the state of Georgia yesterday should have a little bit more of an impact than some of that nuttiness that went on at the Capitol. I think if you're an investor out there and you're investing in individual stocks, what you want to be doing right now is looking over your holdings, trying to determine if anything has gotten too large in the portfolio and think about trimming it back. I wouldn't necessarily be selling anything right here completely out of the portfolio, but what it is just making sure that it is in line with the overall portfolio and making sure that it's not too much of a percentage of the entire portfolio. So if it's 5%, maybe cut it back to 3%. And what I would be focusing on with the money that's being raised is wait for a little bit of a pullback in the market and look for opportunities in the early cyclical sectors. Things are going to do well as the economy improves. Things like industrials, basic material, and with the rising rate environment, the financials. You still want to have some exposure to things like technology and consumer discretionary, but I just wouldn't allow those to be too overweighted in my portfolio right now. I understand that sentiment, and I would be worried about it if I thought that the economy were to grow at a normalized 4 to 5% kind of coming out of a typical recession. But this is not a normal recession. This is still the beginning stages of the recovery. I think interest rates may continue to move up, but they're being moved up by the overall market, not by the Federal Reserve. And so you may see rates on the 10-year Treasury maybe going up to 130, maybe a little bit higher than that. But I don't think it forces the Fed's hands because the economy is still feeling the effects of the COVID-19. So when you think about the effects of the COVID-19, how many people are unemployed or underemployed, and how many jobs that have been lost, at least temporarily, and how many of those temporary lost jobs are going to turn into permanent lost jobs, it's going to be a while before the economy is back on track and you see a real normalization of interest rates. So I think the 10-year Treasury could probably close out the year somewhere around that maybe 130 level. It may go higher inter-year. But I'm not expecting anywhere close to maybe like a 3% on a 10-year Treasury. The Federal Reserve has told us they're going to keep interest rates low, for at least until 2022. So we have all of this year to sort of, work with that low interest rate environment. We don't have pressing inflation, and I think inflation remains at bay because there's not a big incentive for people to go out and try to secure a loan. Federal Reserve has continued to tell you that they're going to keep rates low. I think it's very optimistic that vaccine inoculations are going to increase at a rapid rate. Every indication that we have so far is that many of the states don't have an actual plan. At least they haven't disclosed their plan on how to start vaccinating their population. This is not New Zealand. This is not China. The United States has been handling this extremely poorly. We've seen the long lines in Florida for people that are over 65, miles long, waiting to be vaccinated. Once the general population begins to have that ability to get vaccinated, I can only imagine the nightmare scenario that that's going to bring. So I think the COVID vaccines are going to be slow in coming out. We'll probably run easily the first rounds into the late spring. And then you have to start worrying about the second round of vaccines, the second shot that people have to get. But the market's going to look past that. The market's going to look at the fact that people are getting vaccinated, and that's going to be a positive. The COVID-19 will be an issue that eventually passes. The market's looking past that. So I'm optimistic on the growth, but I don't think we're going to see that 4 to 5% typical GDP growth. I think we're probably going to be in the neighborhood of 3%. So again, I think it sort of keeps inflation at bay, and we don't have to get overly concerned, but I don't think you can get overly optimistic as well. I haven't invested in cryptocurrency. I know a lot of people are interested in it. It's sort of an alternative investment to either gold or to the dollar. A weak dollar is actually not a bad thing for the U.S. population. It means, obviously goods that are being imported from overseas are going to be more expensive, but yet the goods that are being exported are less expensive to places like China and to Europe. So actually, a weaker dollar could actually help the United States, and it keeps sort of commodity prices, a lid on commodity prices. Cryptocurrency as an alternative funding source, I don't think that you and I will probably ever see it. Maybe in somebody else's lifetime, where it takes over. It's just too extremely difficult right now to be able to sort of use that as a form of actual currency, as a form of storage of value. It's still too volatile relative to something like gold to be able to place sort of widows and orphans into. So I think it's a speculative investment right now. If somebody wanted to take that, they would have to have be willing to accept a higher degree of risk than their portfolio. And I think they have to understand sort of the risks that are involved with it and what actually investing in cryptocurrency does involve. It's not as though you're going to your brokerage account and just buying it off, the New York Stock Exchange. So it's a difficult investment to make.